Is the AI bubble finally bursting? I mean, for over a year, the market sentiment was essentially that artificial intelligence could do no wrong. Companies literally just whispered the letters A and I on an earnings call, and their valuations skyrocketed. But suddenly that narrative has violently shifted. We've seen semiconductor and chip stocks taking a massive hit, dragging down the broader tech sector, and really shaking up investor confidence in a way we just haven't seen in recent memory.
To figure out what's really going on, here's our roadmap for this explainer. We're going to look at 1. The AI reality check. 2. How AI shifts the job market. 3. Apple's unique AI strategy. 4. The resilient traditional consumer. 5. The business of fandom. And finally, 6. What the Fed does next.
All right, let's kick things off with Section 1, the AI reality check, fears and fundamentals.
We really got to address the elephant in the room regarding this sudden AI sell-off because we are looking at a stark contrast right now. On one hand, we've got mounting tech and AI anxieties, fears over China's tech competition, widespread chip stock slumps, and a lot of unease over how these tech companies are actually funding themselves. But on the flip side, we're seeing incredibly unexpected consumer resilience. We've got strong travel demand, massive World Cup spending, and traditional industry growth. The irony here is so thick. Tech investors are currently hitting the panic button, yet sports fans are out there happily dropping billions on their weekend entertainment.
Now, this tech drop wasn't just random market noise. It was fueled by specific mounting pressures. First up, geopolitical fears are rising right alongside China's aggressive progress with its own AI ecosystem. Second, we're seeing renewed anxieties over something called circular funding. Think of it like this. Imagine a tech giant handing a massive multi-million-dollar investment to a small AI startup, but with the unwritten catch that the startup has to use those exact funds to buy cloud computing power right back from the giant. It inflates revenue artificially and, understandably, makes investors extremely nervous. Throw in a general unwinding of momentum where investors are just cashing out their tech gains, and that prevailing narrative that AI stocks only go up, completely shattered.
Moving right along to Section 2, AI shifts the job market. Who wins?
Stepping away from the stock ticker for a second, it is endlessly fascinating to see how AI is physically changing the workforce in real time. For example, Visa is cutting 7% of its workforce. That's roughly 2,600 jobs. But they aren't just hoarding that cash. They are aggressively reinvesting those savings straight into AI, cross-border payments, and stablecoins. Why is a traditional credit card company pivoting so hard into blockchain and artificial intelligence? Because they see the writing on the wall. AI efficiency isn't just a corporate buzzword anymore. It is actively forcing massive financial institutions to reallocate their human capital away from legacy operations and directly into future-proofing their networks.
And diving deeper into the hiring numbers reveals an absolute irony. According to data from Revelio Labs, companies adopting AI are actually boosting their senior headcount by 27%, while junior hiring is lagging far behind at just a 6% growth rate. Think about that for a second. The common fear was that robots would come for the executives, but right now, AI heavily favors the experienced orchestrator over the entry-level talent. The entry-level, repetitive, execution-based tasks are the ones getting automated, and that leaves companies desperate for senior managers who actually possess the deep industry knowledge required to prompt, direct, and manage these powerful new AI tools effectively.
Which brings us to Section 3, Apple's unique AI strategy, the outlier.
Get this, Apple recently blew past a staggering $5 trillion market cap, successfully reclaiming its spot as the world's most valuable company. And in doing so, they officially overtook NVIDIA, the absolute poster child of the AI boom. It's such a fascinating rivalry. NVIDIA makes the picks and shovels for the AI gold rush, but Apple's recent surge proves that despite the broader tech whiplash going on, not all technology giants are being punished by cautious investors right now. Bloomberg's Ed Ludlow completely hit the nail on the head regarding exactly why they're so resilient right now. He points out that Apple does not have the massive capital expenditure story that is currently terrifying investors in other tech companies. Capital expenditure, or CapEx, basically just means spending billions of dollars on physical things, servers, real estate, massive data centers. The major cloud providers are currently draining billions in cash to build this AI infrastructure from the ground up. But Apple? They aren't doing that. They're letting others spend the billions on infrastructure while they just integrate the final AI product into their phones while creatively driving consumer revenue with things like partnering with Klarna for new hardware leasing programs. Apple is completely insulated from the current infrastructure panic.
Okay, let's switch gears a bit. Section 4, the resilient traditional consumer, earnings roundup.
Renowned financial analyst Meredith Whitney frames our current reality so perfectly. She calls it a tale of two economies, pointing out that the high-end consumer is doing exceptionally well. And this is the absolute crux of the split-screen market we've been tracking today. While the tech sector wrestles with the uncertainties of future automation and crazy server costs, the traditional economy is still forcefully driving the present. People are out there spending, traveling, dining out, and buying goods at a pace that just continues to defy economic gravity.
If you really want to know how the actual physical economy is holding up, just track how things move: planes, packages, and soda. Boeing generated an unexpected beat in free cash flow, even despite taking a hefty charge on defense contracts. UPS actually raised their full-year sales targets as they successfully pivot toward delivering more profitable packages. And Coca-Cola is moving immense volume, beating overall expectations despite some slight softness in standard grocery staples. When you string all these stories together, the physical traditional economy is churning beautifully. Now, keep this magic threshold in mind, 20%. According to investment strategist Katrina Dudley, if market bullishness drops to 20% during these tech sell-offs, historically, that signals a prime buying opportunity. Bullishness is essentially just a measure of how optimistic investors are, so when only 20% of the market feels optimistic, it usually means the panic is completely overblown. It becomes the perfect time to go bargain hunting for stocks because, as we just saw with Boeing and Coca-Cola, the underlying earnings growth for the broader market is still fundamentally very strong.
So why is the traditional consumer holding up so well? That leads us into Section 5, the business of fandom, global sports boom.
A huge driver behind this consumer resilience right now is the absolute explosion of the global sports economy. That Coca-Cola earnings bump we mentioned, that wasn't just about magically selling more cans at the local gas station. It was heavily driven by a historic World Cup campaign. Coca-Cola leveraged 2,500 content creators to generate a staggering 9 billion impressions. The sheer scale of the creator economy here is just immense. Consumers might hesitate to buy a new car right now, or they might buy a cheaper brand of paper towels, but they will absolutely open their wallets for their passions and shared cultural experiences.
And we're seeing this cultural spending translate directly into massive international business growth. Take Liverpool Football Club, for instance. It's a bit surreal, but this historic British soccer club is actively expanding its physical footprint by playing friendly matches at Yankee Stadium. They are aggressively expanding their direct e-commerce reach into the U.S. market, and amazingly, 40% of their corporate partners are now U.S.-based. They are proving that globalized fandom is a highly lucrative business model, seamlessly turning overseas supporters into a sustainable, heavy-spending revenue engine.
Finally, we gotta zoom out. Section 6. What the Fed does next. The macro finale. So, with all this wildly contradictory data on the table, how on earth does the Federal Reserve actually react? Believe it or not, the odds currently stand at 1 in 3 that influential former Fed official Kevin Warsh could advocate for a surprise rate hike. Yeah, you heard that right, a hike. A hike right now would be an absolute earthquake in the financial world. But the underlying theory is that a hike would establish unquestionable credibility on fighting inflation, signaling to the markets that central bankers aren't just going to blindly lower rates while the traditional economy is still running this hot.
Which brings us to the ultimate question we have to ask ourselves as we wrap up this explainer. If the consumer is still spending, does the Fed dare to cut? Tech might be stumbling, pulling back, and taking a well-deserved breather to figure out its infrastructure costs. But if everyday consumers are out there confidently buying plane tickets, packing soccer stadiums, and drinking billions of dollars worth of Coca-Cola, can the central bank really afford to lower interest rates and risk reigniting inflation all over again? It's a fascinating, precarious balancing act. We'll definitely be keeping a close eye on those consumer numbers, and I'll catch you in the next explainer.